So one of the biggest pieces of the puzzle when it comes to retirement planning is taxes. And what we do is we look to minimize your taxes over your lifetime. So to minimize the taxes, you have to be able to understand the taxes. So this is this first pillar here, and what we think is probably the most important pillar, utilizing strategies to minimize your taxes in retirement. So let's start here. There's 4 different tax buckets. And the first one here is the fully taxable bucket. You are likely very familiar with this bucket because this is where your income comes from. So let's say you work at your job and then you get your salary or your income. That's all coming from that fully taxable bucket. So what that is any income that you have from wages, any income that you have from pensions, any income from Social Security, that's all coming from that first bucket here. And how is that taxed? So when you get taxed, it's not all at the same percentage. It works on a gradual system. So the first dollars that you make, you actually don't pay any taxes on because of the standard deduction or itemized deduction if you decide to itemize. And then after that, it's a very low tax bracket. And then it gradually increases as you have more income coming in.
So obviously then, Frankie, it's better to pay taxes in the lower tax brackets than in the higher tax brackets. You're paying less money.
Yeah, absolutely. So you can see that's how this blue bucket works. And there's also this pink bucket here, and this is the tax deferred bucket. This is where you have your 401ks, your 403bs, 457s, the alphabet soup basically of retirement. You didn't pay the taxes before, but you deferred it. So it's been deferring and it's been accumulating, it's been growing in that account most times for several years without you having to pay any taxes on it until you take that income out of there. Now that yellow bucket, that's the long-term capital gains bucket. And how that works is if you buy a stock or an ETF or a mutual fund and then hold on to it for longer than a year, it gets put in that yellow bucket where you can enjoy oftentimes lower tax rates. So if you make, a low amount of income, that first part is 0, so you don't have to pay any taxes on that if you make a very low income. And then it usually will go up, and then it'll be like 15%, and then if you make a lot of money, it'll be even up to 20%. But that's much lower than the other income tax brackets.
So that bucket basically, Frankie, that's for things like if you own a business, you sell the business, or if you own real estate and you sell the real estate and you've had it for over a year, or stocks or mutual fund, whatever, and you've had it for over a year, then you pay those generally lower long-term capital gain taxes.
Yeah, that's absolutely right. It doesn't just have to be stocks, bonds, mutual funds, all that stuff. It can also be business, it can be real estate, and many other things, like coins and stuff like that.
So Frankie, what about this last bracket here, this black bucket?
Yeah, so that's the tax-free bucket. So that includes your Roth IRA, if you have one of those. That can include cash value life insurance if set up properly, and it can include municipal bonds. So it can include all of those things, and the municipal bonds, the thing about that is it's not necessarily completely tax-free because it can cause taxation on your Social Security. So while it's technically tax-free, you want to make sure that you understand that it can cause taxes on your Social Security as well.
So Frankie, we've had people call our office and say things like, my roof went, I need 30 grand to take that, I need 30 grand to pay off the new roof. Where do I take the money from? That's a pretty important question, wouldn't you say?
Yeah, it's very important to know when you're in retirement, where should I take the money from? And the best place to take it from to start is usually from the bank accounts, because those are earning next to nothing. If you have a lot of extra money in the bank that's not doing anything for you, that's going to be the first place you want to go. Now, if you don't have a ton of extra money in the bank, the next place you're going to want to go is to the non-qualified accounts. Now, that's that blue bucket and that yellow bucket. So in that non-qualified account, if you held it for over a year, if you held a position, an ETF, a stock, a mutual fund for over a year, you're going to enjoy that nice low capital gains tax rate instead of that ordinary income tax rate. And the thing about this is a lot of that money has already been taxed, so it's not a huge tax implication when you take the money out of there in most cases.
And the other thing too, Frankie, is by leaving the funds here, the tax-free funds and the tax-deferred funds, you let them grow tax-free longer and tax-deferred longer. That's actually better in the long run for folks as well, and it can have long-standing implications for them. If they did it the wrong way, they would actually wind up having less money in their portfolio over a longer period of time.
Yeah, and it just makes sense to do that in that order, starting with the non-qualified accounts and then moving to that tax-deferred accounts, and that's the IRAs, the 457s, the 403Bs of the world, the alphabet soup. That's the next place that you're going to go. And then finally, you want to let the tax-free money grow as long as you can, and that's the last place that you would go for income.
So obviously, Frankie, it would be great if people had the bulk of their money in the tax-free bracket, so that when they took money out, they didn't have to pay any taxes on it. Wouldn't that be true?
Yeah, absolutely.
So can you just take money, for instance, from that pink bucket over there where people have most of their money and just put it into the black bucket?
Well, it's not that simple. You can't just move it from the pink bucket to the black bucket, but if you paid the taxes on it, because right now that's growing tax deferred, the only way to get it out is to take the money out and pay the taxes on it. But if you were to take the money out, pay the taxes on it, and do what's called a Roth conversion, you can move that money from the pink bucket to the black bucket.
So that Roth conversion, that's something that a lot of people talk about, but I don't think everybody understands it as well as they should. And a lot of folks don't understand, well, if I have to pay the taxes on that money anyway, why should I pay that taxes on that money now? Why don't I pay the taxes on that money later?
Yeah.
So what the way I would explain that to folks is this: you would rather pay taxes on the seed rather than the harvest. What do I mean by that? Well, let's say you have $100,000 in this bucket. You may have lots more, but let's say you have $100,000 in that bucket, and you're not going to use that money for a while. Okay? The rule of 72 states that if your money averages 10% interest per year, it will double every 7.2 years. If it averages 7.2% interest, it will double every 10 years. So it's conceivable to think that your money could quadruple within 14 to 20 years. So if you had $100,000 in this pink bucket, in like 401k money, IRA money, okay, and you didn't do anything with it, you let it grow tax deferred, in 14 to 20 years, you would now have, let's say you have somewhere around $400,000, you have to pay taxes on all $400,000. But with a Roth conversion, you could take that $100,000, pay the taxes on that, and put it into the black bucket. Now you have $100,000 still in 14 to 20 years. It's conceivable, like we said, to grow to $400,000, but now we have $400,000 tax-free dollars. So that's why they say it's better to pay taxes on the seed rather than on the harvest. So, Frankie, does it make sense then to take, if somebody's got, like, for instance, $1 million in IRA or 401k money, does it make sense to take all of that money and Roth convert it at one time and put it right into that tax-free bucket and put it into a Roth IRA?
No, you really don't want to do that, because if you do that, you're going to see a huge tax bill that year that you're not going to want to ever see. So you can see here that if you have a lower amount of money that you're converting each year, and if you spread it out, you can keep within the lower brackets here. But if you do it all at once, you can see you're pushing yourself to a higher tax bracket, maybe even the highest tax bracket, and those aren't taxes that you guys want to be paying. That's not taxes that anyone wants to pay in 1 year. If you spread it out, it's something that is manageable, is affordable, and is something that you can do and lower your tax bill throughout your lifetime.
So that makes total sense. What you need to do is proper financial planning to figure out how much money you can do Roth conversions with each year and pay the least amount of taxes possible and wind up paying the least amount of taxes throughout the rest of your life. And that's the type of work we do here at A Better Way Financial.